What is going on, investors? Hopefully, guys are doing well out there. It is time for another Fintech Sunday where we take a deep dive into several stocks in the financial space, many of which are down over 50% from their 52-week highs. On today's show, we'll go over from a technical perspective all of these stocks. We'll also do a deep dive into earnings on Sofi since they just reported earnings just a couple of days ago. The rest of these stocks, we've done more in-depth videos. I'll put links in the description down below if you want a more in-depth look at what these companies are doing from a financial perspective. But we will talk about all of these companies, including Block, otherwise known as Square. That stock is down over 62% from its 52-week high. We'll also talk about PayPal as well. This stock is down 67% from its 52-week high. We'll talk about Sofi as well. We'll go over their entire earnings report that just released just a couple of days ago. That stock is down 59% from its 52-week high. I also want to talk about Visa. That stock is down 20%, basically in a correction as well. And we also have Mastercard as well, down 17%. There are timestamps down below in the description if you want to jump around to the stocks that make sense for you. I do want to point out, while we're not going to be talking about in depth on Bank of America, that stock is down 18%, and also JP Morgan is down 22%. We'll use these two stocks when we talk about Sofi as well from a valuation perspective. But I want you to think broadly as an investor. Many of you might have bought in at higher prices on a Block and a PayPal, and look, who could blame you? These stocks were high flying, they were looking pretty good, and they've all fallen off a cliff. But what I want you to think about now that you've had time to think about it and maybe readjust your portfolio is think about the mega caps in this name. This is why we're throwing in Visa, we're throwing in a Mastercard, and I do mention a Bank of America and a JPM. You see how well these stocks have held up even as the broader sector has 50%, even 60% declines on their share price from the 52-week high. This stresses the importance of a diversified portfolio. Now, going forward, we could, and we'll talk about it on today's show, we could potentially see outperformance from the Blocks, from the PayPal, from the Sofis, but unfortunately, it doesn't do you much good if you are in these stocks for a much higher price. If you're like me and you really haven't played around with a lot of these upstart fintechs that have high valuations and high multiples, well, it could be that in the upcoming weeks and months and maybe even potentially years ahead, you see strong outperformance from these groups of stocks. But I want to stress that if you're going to build out a portfolio, I'd love to see you add the mega caps like a Visa, a Mastercard, a Bank of America, a JP Morgan. You could throw in Citi, Wells Fargo, a number of other traditional banks as well to round out your portfolio. If you are overexposed to the highly volatile and highly valued speculative names, well, you see what happens over the last 52 weeks. You can be completely wiped out. Let's kick things off with a Block, otherwise known as Square. The ticker symbol on this one is still SQ. The 52-week high is near $290 per share, and we are all the way down at $106 per share. That is on the heels of February 24th. This company reported their earnings. I'll include a link down in the description below if you want to see our entire video on Square. They had revenues come in at about $4 billion. That was really strong revenue growth, about 29% year over year. That beat expectations by about $20 million. But when we dived into the numbers and dived into the revenue, here's that $4 billion worth of revenue. A lot of it, or some of it, came from this Bitcoin revenue, which we've talked about extensively here on the channel. The fact that you had $1.96 billion in Bitcoin revenue, but you had $1.91 billion in cost associated to it. Essentially, Square's just a middleman taking a small percentage off the middle of those transactions. So it's not a wildly profitable business despite being about half of their revenues. We did see strong growth though in this transaction-based revenue. It went from $929 all the way up to $1.3 billion. That is really strong, but unfortunately with Square, what was also strong was the fact that their total operating expenses ballooned as well. They went from $758 all the way up to $1.2 billion. So a $4 billion worth of revenue. We had gross profit coming in at $1.1 billion, and then you minused off $1.2 billion of operating expenses, and you came down here to a negative $54 million worth of quote earnings. Last year, you were actually positive at $45 million, and you see for the full year, they were actually annualizing out for an operating income gain on a quarterly basis. They earned $161 million from an operating perspective. We could flow all the way down to net income if we wanted to. It just wouldn't paint even as good a story. So when we look at the valuation at a company like this sitting at $61 billion. Yeah, $61 billion off of $17.6 billion worth of revenue. Obviously, the revenues are strong, but we have to keep in mind, off of this $17.6 billion worth of revenue, $10 billion of it, so more than half of it in the most recent year, was attributed to a very, very low margin business. I mean, we're talking about like kind of single digit margins. Off of $10 billion worth of Bitcoin revenue, they realized about $9.8 billion worth of cost. So this is not a very high margin business. So despite the impressive revenue number, you come down to gross profit, you only grossed out $4.4 billion. You had total operating expenses coming in at 4.2, and that's where you get to this 161. So $161 million worth of operating income and a $61 billion valuation. Yeah, this stock is down big, like over 60% from its highs, but I would argue, and a lot of other people, including the short interest sitting here still at 9%, would argue the stock is probably still wildly overvalued. The other thing that I don't like, particularly about Square, but also kind of Jack Dorsey-led companies, as you notice here on this financial, this is on their 10K annual report, this is net income up here. So in 2008, they earned a negative $38 million. It turned positive in 2019, positive net income of $375. Then it went down in 2020, down to 213, and then it went down again in 2021, down to 166 million. So we're seeing our net income actually trend in the wrong direction. And unfortunately, with Jack Dorsey-led companies, he continues to reward himself and the other executives there at Square. You see stock-based compensation went from 216 million up to 297, up to 397, and then all the way up to $608 million. Again, despite the fact that this company's net income line is starting to shrivel up year over year, it's not a great trend. And so there, in some cases, when you just look at this in a vacuum, the fact that this stock is down about 60% from its highs, and really even just over the last couple of months, this stock is down big. Some of it makes, in fact, a lot of it makes sense when you factor in their revenue growth is attributable to a low margin business. And on top of that, they're not really flowing a lot of money down to the operating side or the net income side. And in the most recent quarter, their operating income and net income actually turned negative, and that is not a good sign. Now, from a technical perspective, paints a little bit of hope out there. If you've, thinking about buying the dip in this one, if you bought up here at these higher prices over $200 per share, well, I think you got to forget about it. I would have set a stop loss somewhere along here. We won't necessarily get into that, but there was plenty of chances to get out of this stock. Notice the tight channel. So I've got these kind of red lines here. There's a lot of red lines on here, a lot of red candles. Notice how tight this downward channel has been over the last couple of months. It started back in October, and it's just been on this tight channel downward. What you're looking for is a break out of the channel, and after earnings last month, the stock has actually broken out of this channel. And so I'm going to clean this up a little bit and take some of these lines off so you can see this a little bit better. Is notice that we did bottom out in an area of support. I had this area marked out for a little while on Square, down here at about $84, $85 per share. This is where the stock peaked out many times back in 2019, 2020, really before it went on its epic run. And a lot of stocks went on an epic run after the March lows. The stock bottomed out at 38, but then once it broke above 85, it was kind of off to the races, but it was acted as an area of resistance. And then once it broke out, boy, it was an area of kind of springboarding. So this $85, $84 area with Square, very critical level. And we saw it hold true after earnings. The stock bounced like literally almost to the penny off of that number, and then bounced up quite a bit and has pulled back. And some people might be, a little concerned about this pullback. I wouldn't be, because this bounce took us over the previous sets of highs. We're here at 110. We got all the way up to about 120, 130. Now we're pulling back to 106. No big deal. What I would like to see Square do is actually pop back up above the previous highs here at 136, and then maybe make one more pullback, okay? And what are we looking for here on the channel? We've been looking for this with a lot of stocks. We're starting to make higher lows, higher sets of lows, and on top of that, higher sets of highs. Instead of making a down channel, which I showed you right at the top, okay, Square has been making this downward channel. And when stocks are in this downward channel, you do not, I repeat, you do not buy the dip on a downward channel stock. You wait for it to break out and actually start what appears to be maybe like an upper channel. When you start creating these upper channels with Square, you can absolutely buy the dip on this one. Would I step in here right now. Technically, we're still at a higher low here at 107. Again, this stock bottomed out at 85, popped up to 130, pulled back to 108 or so. Could you buy the dip here? Maybe. I wouldn't necessarily be really aggressive. If you wanted 10 shares of this, maybe I buy one at this spot. I wait and see what happens with this stock. I think we're expecting some kind of green candle, some kind of relief rally at some point. You'd like to see it take you to the top of this channel, which would take you over about $130 per share. Do not be alarmed when the stock goes up this high and you're saying, hey, I missed it. More than likely, it will trigger some selling in the name. You get a pullback, I think, on this third leg back down. As long as it doesn't go below the 108, 106, really, quite frankly, you really wouldn't want to see it get below 85. That would just basically mean this was a temporary breakout, which certainly it could end up being. That is why we're not necessarily recommending, and even myself with my own money, I would not step into this stock. This is one that you have on your watch list. If you're into this one at a higher price, I would not blindly just double down on this one or dollar cost average into this one. I would wait for the technical setup to be right, because if you can get this one in the right technical setup, while the upper channel might not end up being this steep and go back up very quickly, you could have a much shallower upper channel on this one, and then all of a sudden over the next 6 months, 12 months, you have a very, very good performing stocks. I would not, and I repeat, I would not expect these stocks to just rocket back up to where their highs were, even over $200 per share, because we walked through the valuation on this one just simply does not make sense from an earnings per share basis, even from a revenue perspective, and just from a market cap perspective, still over $61 billion. Just doesn't make a lot of sense at the current time, but at least we have evidence, at least at the current time, very small amount of evidence. This stock could be wanting to make a reversal, and that would make it interesting from a technical perspective over at Square. The next stock that we're going to talk about is PayPal, and this stock is down the most from its 52-week high, down over 67%. The stock was up over $310, and now it's currently sitting under $100, which certainly has shocked a lot of investors out there that have been stuck in this one. Now, there has been some rumors over the last couple of months, considering a lot of stocks have pulled back, including Pinterest. This stock was well over, it was close to $80, $90 per share. Now it's a $24 stock. PayPal was rumored to potentially be in the market to purchase this stock. Now that it has come down to a market cap closer to about $15 billion. Well, there's a lot of rumors out there that PayPal would be a buyer of this stock. We'll see if that ends up materializing at some point. Don't necessarily think that'd be the greatest thing for PayPal shareholders, considering how they would have to finance a deal like this, even if you got it in that $20 billion range. It's a company with not nearly that much from a balance sheet perspective. Now, what is driving PayPal going down? I think for one, a lot of these payment stocks, including PayPal and Square, just simply got out over their skis. This still has, even despite being down over 67% from its highs, PayPal still has $116 billion market cap. And when I show you these financials, I have a more in-depth video. I'll have a link in that description below if you want to see all their financials, but I'll go over it from a high level here in a moment. This company is still, in my opinion, just wildly overvalued, okay? You've got over $116 billion market cap on this one, and you got $25 billion worth of revenue. That is for the full year of this last year. You come out here to operating expenses, you have $21 billion in operating expenses. So this is not a high margin business, okay? And none of these companies actually operate on what is considered to be a high margin business. So off $25 billion worth of net income, or net revenue, you minus off $21 billion in operating expenses, and you come down here to operating income of just $4.2 billion. That's not for a quarter. That's for an entire year. $4 billion in operating income, and you've got a $116 billion market cap on this one. It's pretty still, while it's definitely not where it used to be. Okay, this stock obviously was 67% higher from a market cap perspective. It's not where it used to be, not as wildly overvalued as it used to be, but this is, don't confuse this with maybe being potentially a value stock, because it absolutely isn't. Now, I think just investors digesting the multiple on this type of stock and a number of different stocks in this sector was one of the things, but also the guidance just started to come in a little bit murky. These companies obviously pulled forward a lot of demand for their products during the pandemic. People were sitting at home. They couldn't go out and spend money normally, so they started using a service like PayPal, okay? People that normally use PayPal anyways were still using it, but a lot of people that had never used PayPal before, never had to use it, all of a sudden had to pick up the service, and I think these companies pulled forward a lot of demand, and we're not really seeing follow through on that in subsequent years. That certainly has hurt the sales numbers and obviously the market cap over at this company. What it also hurt was guidance over at PayPal. The company expected their Q1, this is adjusted EPS, so it probably adjusts out things like stock-based compensation and other things that PayPal wants to adjust. Well, that's going to come in at 87 cents in the upcoming quarter. The consensus was for $1.16. For the adjusted EPS for the full year, the company expected between $4.60 up to about $4.75. Consensus was for adjusted EPS to be closer to $5.26 per share. So this company came underneath guidance, and on top of that, the momentum of the stock had just completely fallen off the table. Now, from a technical perspective, over at PayPal, it just looks like an absolute disaster. This stock, a lot like Square, which we just covered, is and was in this big down channel. And when you see stocks in this downward channel, you do not want to buy the dip. And this one is gapping down all along the way. Now, there are some signs of life down here, all the way down here at $90 per share. We have broken through so many levels of support, though. This level of support actually probably should be closer to about $100 per share. We had a level at 125. We had a level at 180. We had a level all the way up here at 226. It has just cut through this at like a hot knife through butter. And I tell you what, if you break through this $100 level, well, you're coming down likely down here to about $77, $78 per share, because that is the next stop on that train. Now, in the shorter term, though, this stock is making what it appears it wants to. It wants to make a higher low here. So we made a low here at $94 per share. If this level right here, and one of the reasons why we think this level could potentially hold this $100 level is it's acted as a level of support before. It acted as a level of support way back in 2019 for this stock for a very long period of time, for like almost a year. This $100 per share acted as a pretty firm level of support. That's why it is such a critical level. If PayPal is not able to hold this $100 level, well, we're just assuming there are just a ton of sellers in the stock, and this stock is likely going to head down much further, probably down, and I would guess another $20 down to about $80 per share. But if this stock can hold this level at 100 and get a nice little bounce, I would expect it to bounce up into the area up here where we have some resistance up into the $123 range. Some of you might say, well, I got to get it. That's a $20 per share. Now you got a lot of risk. You don't have a lot of risk reward here. Okay. Your upside is $20. Your downside is $20. You'd like to flip that on its head, quite frankly, and give yourself a little bit better upside. That is why personally, I would wait on PayPal until we started make this type of formation with the candles. And this could take weeks. It could take months. It could even take days, but more than likely you're looking over another couple of months, maybe a quarter or two, for this stock to start working its way up. This, again, I'm giving you kind of the bull case scenario. I already gave you the bear case scenario. We break this $100 level and then all of a sudden 80's in play. And if you want to talk about breaking through 80, well, you're coming all the way down to the IPO price back at $40. I mean, it's just as simple as that on the bear case scenario. On the bull case, we come up here, retest 120, 125, pull back, come back. I'm looking for green candles over 125. And here's the reason why I'm looking for green candles over this price action is because you've got a ton of airspace back to the level of support at 180. Now your risk reward would line up with PayPal. So just have a little bit of discipline with this stock. And I'll be honest with you, I'll be playing along. I am telling you exactly what I would be doing with PayPal. We would have a breakout above 125. I would set a stop loss down at maybe 119, just in case I'm wrong, just in case we come up here and the stock market breaks down or this stock breaks down and it takes a dump. Well, I wouldn't want to lose a bunch of money and tell people that bought this stock over $300 the importance of a stop loss. So I'm looking for a candle or two over the 125 mark on this one, because then your risk reward is back up into the 180s. You've got $40, $50, $60 in upside, and I would take like a $3 or $4 stop loss on the risk. That is the risk reward you want to set up, especially when we're looking at stocks like this that have pulled back this much. You want your risk reward to be extraordinarily high. $3 or $4 in downside, $60 in upside. I would take that all day, every day. If you're right, just a small percentage of the time, you're probably setting up for a winning portfolio, winning trade. And I'm setting this up as a trade because, quite frankly, I still think this company, from a market cap perspective, is still wildly overvalued. I also think there's a lot of competition in this space. If you believe in this company in the long term and you want to set this up as a long position, I would still play it the identical way that I described to you. I would not step in here and buy the dips on this one, because if you've done that over the last few months, you've been absolutely obliterated from a price perspective. That was PayPal. Now we're going to take a look at SoFi. This will be kind of a full earnings video since this company reported their earnings last week. From its 52-week high, SoFi is down 59%, and this one is quite frankly approaching penny stock territory. It's down to about $10 per share. The all-time highs on this stock was closer to about $25 per share. Now, SoFi is being aggressive. That's one of the reasons why I do like this company, and from a speculative investment perspective, I would like this company because they're being really aggressive, okay? The management over this company is really trying to grow this and really trying to turn SoFi into just a gigantic brand. SoFi is to buy Technisys in an all-stock deal for $1.1 billion. This company has banking software that will integrate well with SoFi, and the reason why $1.1 billion is such a significant portion of SoFi is because the total market cap on SoFi is actually under $10 billion. So this represents over 10% of the company. Now, what are you going to get for it as a shareholder? Or are you going to get a massive amount of dilution? Okay, this is an all-stock deal, meaning they're going to issue over 84 million new shares of SoFi, and we'll talk about this from a dilution perspective over at SoFi, how this stock just continues to dilute you as the common shareholder, and that, among a number of other different factors, which we'll talk about, has driven this stock price down and down and down. So while management is being aggressive, and we do like that, it's not necessarily shareholder friendly, and it has sent this stock reeling over the past few months. Now, the company reported their earnings on March 1st. We're recording this on March 6th. They had revenues at $279 million. That was 53% year-over-year growth. You're not going to find that in a lot of traditional banks out there. SoFi is expecting the upcoming quarter to have revenues in that 280 to 285 versus the 300 million consensus, and I think this is why the stock traded off in subsequent days. Is number one, you had the realization that you're going to have massive dilution at this company, and also they're coming underneath consensus estimates for their revenue guidance at 303 in the upcoming quarter. They're planning to the upside to be at 285. We talked about how in the most recent quarter they were at 279. Now, the company did give us guidance for the upcoming year. That is going to come in at $1.57 billion. That is for a full year revenue guidance. Consensus was much closer to $1.45 billion. So while they came up a little bit light in this Q1, it looks like SoFi is anticipating as we move through the year. Maybe this has to do with maybe getting the bank charter, which is certainly new to SoFi as well. We don't have a press release on that, but SoFi has become essentially a traditional bank. They can take traditional deposits and loan that money out just like a traditional bank. That's why in a moment here, we'll look at this stock from a traditional valuation perspective and actually compare it to a Bank of America, a Wells Fargo, and a JPN. While their business models vary quite a bit, especially when you compare SoFi to the other three, we can still start to evaluate it from a traditional banking metric since they have that bank charter. And it could be that towards this second half of this year, as we get into the springtime, the summertime, and the wintertime, this company is projecting stronger revenue growth. And I certainly could see that with all the investments that SoFi has done in their business. Now, the most recent quarter doesn't probably paint a lot of that picture. It doesn't have a lot of that impact from a traditional banking perspective. And we also haven't seen rates really rise considerably, especially when these results were completed at the end of December. You went from $92 million up to $94 million on that net interest income. And then we noticed for the most recent quarter, man, the total interest expense really bottomed out, went from $53 million down to $18. That really bolstered up our net interest income off $94 million in sales. You minus off $18 million in costs, and you get to $76 million worth of income from just interest income. Now, non-interest income like fees and loan originations, that's still the bread and butter butter business over at SoFi. It'll be interesting to see how much they pivot away from that. That's certainly still going to be a big business for them, but when they have this bank charter, I think you'll see larger growths up here in this interest income. And we see on that non-interest side, they ballooned to $209 million worth of revenue. That was up from the previous year at 132. But unfortunately, when we look at our expenses over there, it's big time. I mean, over $395 million worth of cost to generate this $209 million worth of revenue. And so this is why this company has a pretty massive short interest. You look at 15% short interest on this one, and certainly they've been doing great over the last few months on betting against this company, and really since the beginning of it. And I would guarantee you most of the shorts are looking at this, the fact that their number one business revenue model is absolutely wildly unprofitable. So you add all of this together and subtract all your costs, you get to a loss before income taxes at $109 million. That accelerated over the previous year on a quarterly basis. You went from a loss of $87 million up to this $109. It holds true for the full year as well. You lost $328 million all the way up to a loss of $481 million. This company doesn't look like it's anywhere close to being profitable. That would put it in my book, kind of on the no-touch list. Even when you come down to their balance sheet, not particularly healthy, quite frankly. This is why they have to continue to issue shares in order to complete transactions and do these $1.1 billion worth of deals. Well, they don't have the cash on the balance sheet. You see here, they have $500 million in cash and they got another $273 in restricted. That is down from the previous year. They also have over $3.9 billion worth of debt on the balance sheet as well. This is not a particularly healthy company from a balance sheet perspective. It's not that it's unhealthy, but it's not like, we could pull up the balance sheets of a lot of other banks and they're far more healthy than a stock like this. This is why other banks do buybacks and things like that. Now, you could analyze this from a cash flow perspective. I don't typically do that, but we do see here from the financing activities, you issued $9.5 billion worth of debt. You paid off about 10.5 of it. You had the proceeds from the PIPE investment, about $1.9 billion. That's where the vast majority of the cash has come from on this company's balance sheet, because it's negative from an earnings perspective. And it's just a lot of negative trends from this company from an earnings perspective. Just from a fundamental perspective, I would not want to buy SoFi stock. You also look at the dilution as well. Last year, you had 78 million outstanding shares. Now you got another 814 million, and that is before they complete this acquisition, where they're going to have to probably do more shares of this. Okay, when this deal was announced, the stock was up over closer to $11 per share. It slid another 10% since then, so they're going to have to issue another 8 or 9 million shares. This is likely going to be pretty close to 100 million more outstanding shares. That is going to dilute you further as an investor, and you'd have to imagine many of those shares are going to end up on the open markets. Now, from a traditional valuation metric, the one metric that we look at when we look at all banks is price to tangible book. Essentially, if you were to liquidate the assets on the bank's balance sheet, this is the price you're paying for those assets. And you see a traditional bank like Bank of America here in blue is a 1.8 times tangible book. Wells Fargo, which certainly has come under scrutiny and has its troubles, is trading at a discount to its peers, trading at 1.3 times. JP Morgan also trading at closer to where Bank of America is at about 1.9. SoFi at the current date. And look, I know their book of business is different than Bank of America, and they've just gotten that bank charter, and that really hasn't flowed into their financials yet. I understand this, but we also have to factor in Bank of America and JP Morgan in particular have a book of commercial and investment bank business that SoFi will likely never get a portion of. So there's some give and take on both of these sides. And when you see price to tangible book over at SoFi at 2.64 times, it trades at a premium to Bank of America, Wells Fargo, and JP Morgan. And Bank of America pays a dividend. Wells Fargo does too as well, I think, and JP Morgan does as well. And all of these stocks, except for maybe Wells Fargo, is buying back their shares as well and not issuing them like a SoFi is. Just all things being considered from a fundamental perspective, it's a disaster over at SoFi, but period. It's a disaster, okay? And then from a chart perspective, a technical perspective, absolute disaster as well. We're in a pretty steep downward channel on this one. We would not, I repeat, we would not even think about buying this one until we probably put 2 or 3 green candles up over this upper trend line. And you're probably saying to yourself, well, we've done that before. No, this is a red candle. A red candle over the upper trend line does not count. A wicked green candle. So when you get these thin green lines here, this is just intraday price action up over this channel, and the sellers were like, psych, we're just hitting you back down into the channel. We're looking for solid green lines up over this channel. I wouldn't expect it to happen anytime soon with SoFi, considering the fundamentals I just outlined with this company. It's an absolute, complete, and utter disaster. Assume that this stock will be locked in this downward trend until it reverses itself. Now, if it does reverse itself, it probably will do so very quickly because this stock tends to go on these massive rallies. If this stock goes on a massive rally, I would be looking to be a seller of this stock, not a buyer, because as you have massive rallies in this stock, all of a sudden that traditional valuation metric starts to look even more out of place when compared to the traditional banks, which again pay a dividend, have a much larger book of business, have a much larger margin of safety, and are also too big to fail. A bank like SoFi, if they find themselves in financial troubles in the coming years ahead, will not be too big to fail. Moving on to Visa. Now this stock, look, it's a little bit different than some of the other stocks that we've been doing, but I tell you what, if you want to build up a portfolio, especially if you're into the blocks and the PayPals and the Squares, look, I think you need stocks like Visa inside your portfolio because quite frankly, these stocks like PayPal and Block actually operate quite a bit because of Visa and Mastercard's network. And so I love these stocks from that perspective. Not only that, we're seeing that this stock is still holding up pretty well, and I'll show it to you here in a technical perspective as well. This one actually has held up nicely, and quite frankly, it looks like to me it could be setting up for a reversal, and you could actually step in here and buy Visa actually on Monday or right after you watch this video. We'll talk about that here in a second. So I want to talk about Visa again, down about 20% from its highs. We do get a dividend with this one. We do get evidence of a buyback as well. This stock is very shareholder friendly, unlike some of the other stocks that we've looked at here on the channel. Now, Visa and Mastercard suspend their operations in Russia due to that invasion, and they noted, Visa did disclose that it was about 5% of revenues was exposed to Russia and Ukraine. This is probably why we saw after announcing this, stock went down about 3% because boom, it's going to be hard to replace this revenue, right? Okay, 5% of your revenue goes away. It looks like to me, at least in the shorter term, that revenue is not going to be replaced in the most current quarter and maybe not even the next quarter, and who knows when it will be replaced. Obviously, we hope that it will at some point. Now, from a technical perspective over at Visa, I kind of like what I'm seeing, and I'm glad I pulled this chart up because I might actually step in here and look, I already have a small position in Visa, and it's something that I like to add to just small pieces. Again, when we're building out an entire portfolio, you have to factor in how much you want into Visa, okay? And how much of your entire portfolio you want in kind of that financial sector. So if you got a $10,000 portfolio, $100,000 portfolio, you want to start, categorizing how much you want to add to these stocks. And Visa's one that I like to add to consistently when it dips. And we notice really over the last year or so, this stock has been range bound, okay? It's been down here at the bottom of the range, down at about 190. Sellers start to emerge once we get over 230 on this one. But we notice in the shorter term, I put these two green kind of trend lines kind of trending up. Notice we're making low here at 190, higher set of lows here at 195. If this 200 level would hold, this is what we're monitoring probably on Monday or Tuesday of this next week. We're looking for this $200 level to hold and put up kind of a green candle up in here. That could be a very bullish sign. The other thing that kind of confirms this as well is we're making higher sets of highs. So we had a group of highs here at 220, a higher group here at 225, and then we made a higher group up here at about 230 on this one. This looks like to me, at least at the current time, it's starting to reverse. Now, it's done that before, okay? It did that all the way along here, and then it completely broken down. So you just want to keep that in mind. As we get to the top of the channel, this one's likely to pull back. If you want to play this like a trade, if you want to just lock in profits on this one, you want to think about this. If we bounce here at this $200 level, which I think it probably will. As you move north of about 210, 220, sellers should emerge on this one. On the really bull case scenario, you really need to get above all-time highs, which are closer to 250 on this one. And for what it would take to get it there, certainly there's some tailwinds behind a company like Visa with cross-border travel and people kind of getting out of their homes and spending money. Certainly could materialize, but I think in the shorter term, this one is setting up for a bounce. So if you want to play it that way, if you were to play it that way, I would set a stop loss below the previous lows. You would not want to get below this previous set of lows at about 195, okay? And you could maybe even drop it just a little bit lower than that, because technically you would not really want to get below about 190 on this one. Below 190, I mean, I'm having a stop loss no matter what at 190 on this stock, okay? If it gets below 190, it is a territory that we have just, quite frankly, haven't seen over just a couple of days over the last year or so. Would not want to see what happens from a technical perspective, this stock getting down below that. But depending on how we open up on Monday or Tuesday, I think you could buy this one at 203, 204, set a stop loss down here at 195 or so, and play the run up back up into 200, 220. I'll let you decide how you want to get out of a positive trade, but this one is setting up kind of interesting. And finally, we'll take a look at Mastercard. This stock also is down about 17% from its 52-week highs. We'll talk about that from a technical perspective here in a moment. Just like Visa, Mastercard disclosed that about 6% of its revenues were exposed to Russia and Ukraine. This is probably why the stock slid off by about 3% after announcing this news. The fact that this company is going to have a difficulty replacing that revenue. Now, what I did want to look at as these stocks continue to pull back, Visa and Mastercard from a technical perspective are almost in the exact situation, okay? They both have kind of flagged sideways for a long period of time, really about a year or so, and are near the bottom end of that technical range. And so what that typically does too is also compress your multiple. Since this company was able to report revenues and earnings, probably stronger earnings and revenues, well, the multiple's starting to compress over at these companies as well. We've got a price to earnings on both of these. Mastercard sitting at 37. It tends to trade at a premium to Visa. I'll let you decide if that's fair or not. And then Visa's trading about 33 times earnings. Again, these companies we've seen over I've got a 5-year chart here. They don't tend to go lower than 30 times sales. And while we're not there yet, we're getting very, very close. And in the case of Mastercard, I mean, this thing bottomed out at about 25 times sales, but that was back in March of 2020. So we could have a March of 2020 event where the whole stock market kind of get washed out in a matter of weeks. That is potentially possible. Stocks like Mastercard and Visa certainly would not be immune to it, but we're not that far away from a multiple perspective on a price to earnings basis. That's why I like these stocks. And then from a technical perspective, I kind of like what we're seeing as well. I see that we have a big green line on. This was left on last time we did an earnings call on Mastercard, and we talked about how if we were up here at the top of the range at 392, it's coming down, and sure enough, it did that. It came all the way down to the bottom of the range. We've got some support down here at about $320 per share. If you want to buy this stock from just that perspective, the fact that it's hit this bottom end of the range, because this range is held from August of 2020 all the way to the current date of March of 2022. I mean, we're almost like 2 years of sideways consolidation on this stock, and 325, 320, somewhere in that range has certainly held. This is where I could see adding a position into Mastercard. I wouldn't necessarily be really aggressive in this because, like I talked about, if we have a big washout in the market, this one's likely coming down south of $300 per share. But if the market can find its footing, we do have earnings on this company coming in May of 2022. So not that much longer until we get some positive news from the earnings front on Mastercard. I certainly see us considering a bounce up here at the 330 level. I think we could come back into the middle of this range, which is closer to about 350, 360 on this one. I could see you bouncing up into this range. Now, from a technical perspective, though, you are sending a mixed message. It's created a low here, a higher set of lows, but then we kind of canceled that out with a lower set of lows. But all along the way here, we're creating a higher sets of highs. Again, this is more intermediate term. In the shorter term, this stock is in a steep downtrend. That's why if I were to step in here and buy the dip on this one, I wouldn't be overly aggressive in this one. It would be a very, very small position, just figuring that this level of support in this 320 to 330 range would likely hold just like it has over the last 2 years. Folks, that was Fintech Sunday. We'll be back again next weekend with another group of stocks. Hopefully you guys enjoyed today's video. Good luck with your investments.